Investing in stocks seems like it's all hidden away in the shadows, but if you break it down, you'll see that investing isn't as hard as it seems. The key to a successful portfolio is thorough research, defined goals, a good strategy, and an investment platform that will support you along the way, especially if you're self-managing. But before investing in stocks, you need to assess your current financial situation. Don't just invest blindly, make an informed decision. Here's the ultimate guide that will answer beginners' questions on how to invest in stocks. Make sure to stick around till the end for a bonus tip on how to start investing with little money. But before we dive in, remember, nothing you see in this video is financial advice. These videos are intended for educational purposes only. Please always make sure to do your own research and consult with a licensed professional before making any investments or financial decisions. You can find all useful links in the description box below. What is investing and how does it work? Investing simply means putting money into an asset and waiting for it to grow in value. You hope to make a profit by selling it again at a higher price. An asset is anything of value, like stock shares for an investor. The value of the asset can go up or down, so it's important to watch out for this. To invest, you'll need to buy a financial product known as an investment. There are many types of investments, such as stocks, which is buying a portion of a business, property, which is investing in property to let, bonds, which are government loans, and exchange trade funds, which are investment funds that track the performance of an index such as FTSE 100, and the list goes on. Why should you invest? Here are 3 reasons. 1. Building up cash isn't enough. The emergency fund should be easy to withdraw money from when something goes wrong, but if you have significant savings, then it may not be the best idea to keep them all in cash. This is especially true when the cost of living is going up quickly like it is now. The cost of living keeps going up, and on top of that, the low interest rates from banks and building societies aren't cutting it in terms of beating inflation. If you leave all your money in a poorly performing account, the value of it is actually declining. 2. Your money can really multiply in the long run. It's a good idea to invest your money so that it has the best chance of going up in value. For example, let's assume you invested $5,000. If you put the money in a savings account paying you an interest rate of 2%, that pot would be worth $5,500 after 5 years. By comparison, if you invested the money in the S&P 500 assuming 8% average growth, then the same pot would be worth $7,000 after 5 years. And because of inflation, the money in your savings account is worth less than when you first set it aside. In real terms, it's worth even less. You might be asking yourself, what is inflation? Simply put, inflation is the rate at which prices are rising. For example, if a 1 pint of milk costs $1 and that rises by 15 cents, then the inflation is 15%. So with the same amount of money, you are able to buy less. 3. The power of compound interest. Einstein called this the 8th wonder of the world. Imagine a snowball rolling down the side of a hill. The longer it rolls, the more snow is packed onto it, and the larger it becomes. And because it's bigger, the more snow it can collect. That means that in even less time than before, more snow will pile up on top of it and make for an even bigger snowball. Now replace the snow with money. The longer you give an investment to grow, the better. You'll have your original investment, plus the return you make each year, and that in turn will earn interest. Effectively, interest earns more interest, so the money in your account starts to grow even faster. What should I do before I start investing? Before you buy shares or funds, you should pay off any expensive debt like a credit card or overdraft before you invest. Otherwise, the interest paid on that debt can quickly eat up all the gains from any investments. B. Have an emergency fund that contains 3 to 6 months' worth of your regular earnings. Keep it somewhere safe and easily accessible. It's money for things that come up, like when your heater breaks. Do I need a lot of money to invest? Absolutely not. Investing traditionally has been seen as something only the rich can do. However, with the reality of investing now being that it doesn't require a lot of money to start, investing has become much more popular among all socioeconomic classes. There are a number of investment platforms which enable investors to register, trade, and invest with as little as $1. This is perfect for beginners and allows them to get practice before investing any larger sums. One thing to remember is that most, if not all, investment companies charge a fee on your investments. Types of charges you'll find are: platform or management charge. Companies tend to charge money for their services. This fee comes out of your investment. Annual charges. This is what it costs on a yearly basis to have a company manage your investments for you. Fund charges, sometimes called the entry charge. This is an upfront charge paid when you invest money in a fund and is deducted from your investment before you invest. When deciding which investment to make with your money, it's important to ensure you're aware of all the charges you'll have to pay so they don't disrupt your investments. Is my money at risk when investing? Whenever you're investing, there's always a risk involved. The value of an investment can go up or down, so it's important to understand that you may not get as much money back as you initially invest. We recommend that you save some money and put it aside as a buffer for emergencies, like if your car breaks down. That way, you still have access to your money in the event that you need it without having to liquidate your investment. Investing for a longer period of time allows you to ride the ups and downs associated with the market, effectively preventing you from selling your investments at the worst possible times. Always remember that with any investment you make, there's always some risk involved. It doesn't matter what kind of investment you're making. You may still be scared about investing, but it's important to remember that nothing is without risk when it comes to money. That's because when you invest, the markets can go up and down, but when saved, inflation eats away at your savings. Putting your money in a savings account can feel like the safest option, but you'll lose some money to inflation. That means you won't be able to buy as much in the future. How to find stocks to invest in. The next time you're deciding on what stocks to invest in, here are 5 pieces of advice that should come in handy for a newbie investor. Determine your financial goals and purpose of your portfolio. Before you start investing, first consider what your goals and expectations are with regards to investing. To figure out your investing goals, ask yourself the following questions. Are you planning on short or long-term investments? How much disposable income are you able to invest? Are you trying to build up a solid portfolio for retirement? At what age do you want to retire? What's your risk tolerance? These questions can help you figure out what your goals are for now and in the future, so you can start planning a strategy to meet those goals. Research and find companies with potential. When you get a hold of your goals, the next step is to research which companies will be worth investing in. Take into account the following considerations. How a company measures up to competitors. A good way to compare companies to competitors is by looking at their growth potential. How does this company stand up to the competition? What kind of market share do they have? Is there a strong competitive advantage that sets them apart from everyone else? A company's long-term stability. The stock market may be up and down, but the long-term stability matters more. It's an indication that the company is doing well and has balanced debt levels. The effectiveness of company leadership. Don't underestimate the power of strong leadership. A common signal of a company with an established culture is leaders who have been in place for a while and already have a lot of insight into what makes the business work. This can also show that they've got expertise, which is good because it means they'll be able to provide better support and guidance to continue generating profits for its investors. Listen to quarterly earnings calls or transcripts of other speeches to get a feel for their character. How dividends are handled. If a company pays dividends, that's often a sign they're in good financial shape and plan to stay that way. This is especially true if the company has increased yearly payouts. But be wary of sudden spikes, as it could show something like a lack of self-investment or desperation. And no dividends can be a sign that they're struggling financially through the hard times. Getting started with stock investing. Once you know the basics, it'll be a lot easier to get started with stock investing. Determine your investment style and risk tolerance. Ask yourself these questions so you can find a suitable investing style that will match your needs. Are you a risk taker or more risk averse? Are you looking for long-term growth or quick gains? Will you handle your own portfolio, hire an advisor, or invest in a fund? Remember, investing in stocks always presents certain risks. You might have heavy fluctuations in a short period of time or losses over the long term, but you could also make a lot of money. If you're unsettled by market volatility and worry about it often, then you might want to consider low-risk investment options. Heed these tips to create an investment strategy. Here are some tips for you to use when you create your investment plan. Think long-term. Stocks are a great way to grow your wealth. The best strategy is to invest for the long term. Over the past 10 years, the stock market usually appreciates by 9% annually. If you're investing for decades, this can really add up. Ride out volatile markets. Yes, there will be ups and downs. We said already that the stock market is unpredictable, so take a minute to breathe during turbulent times and don't rush anything. This too shall pass. Invest consistently. Dollar cost averaging is a great way to build wealth over time. This approach involves investing the same amount of money into the same stock at regular intervals and ignoring share price. With this technique, you never need to worry about your investment performing poorly. Start small and keep reinvesting your gains. It's one of the best ways to jump into the market while still keeping the long term in mind. Diversify. If you invest your money in one single stock or line of industry, you run the danger of losing everything. Spread it around. By finding different industries, sectors, or stocks to invest in, you're decreasing risk of losing too much at once. For example, if you only invested in real estate in 2008, your portfolio would be wiped out by the 2008 real estate crash. Choose an investment platform. Online stock trading platforms charge a fee to buy and sell stocks for the investor. When choosing a platform, keep the following in mind. Fees. Some platforms charge exorbitant fees, but others only charge as a 1% commission when you buy or sell stocks. Funding methods. Some platforms only have limited account funding options, like linking your checking or savings account. Others may allow you to wire transfer money, transfer funds from another broker, or deposit a check. No matter what your preferences are, make sure you identify what funding options the company has for its accounts before opening one. Platform usability. How easy is it for you to use? If you are the type of person that doesn't like to get help and be told what to do, then the platform should have a simple interface. Availability of support. It's also important to find a platform that'll offer guidance and support when you need it. Trading can be intimidating since this is new territory for you. It can be reassuring to have someone or something on hand to help when a trade doesn't go as planned. Determine how much you want to invest. In regards to how much you invest, you'll want to determine what percentage of your pre-tax income you can afford. Many financial planners advise investing 15%. But this depends entirely on your financial goals and whether you're a high-risk or low-risk investor. You might find it easier to reverse engineer your financial goals. For example, if you want a nice cushion of $100,000 with an average annual return of 8%, you would need to invest $5,000 yearly for 19 years. You can use a free online compound interest calculator to play around with the number and see the impact small changes have over time. How to start investing with little money. Money is great and we all like the sound of more, but it shouldn't be a deciding factor in whether or not you invest. Really small amounts can grow slowly and steadily over time, so don't feel that you don't have enough to start with. And with micro-investing, they're easy to get into because you can just buy the shares in smaller portions. Instead of having to buy the full share or pay a broker, it's really easy to get up and running. And remember, a little goes a long way. To summarize, research a company first before investing in them. Have a long-term investment plan to take the wind out of the rough markets and invest with patience.